Traders, it was a relatively tricky week last week, with the market ending pretty much lower for the week across all the assets, whether we're looking at currencies, whether we're looking at indices, or we're looking at commodities. It all sort of bounced on Thursday and Friday with a bit of a bid coming into the market. It sort of seems like the market found a bottom on Thursday, whether we're looking at stocks, and that sort of flows through, came in on Friday. How it plays out this week, yeah, that's the million-dollar question. I think if we look at the US 10-year bond market, I think this has peaked. We're now seeing a bit of a head and shoulder pattern forming up here with your neckline across here. And the bond market generally runs in front of the global economy. The bond players tend to be the smartest guys around, and I just get the feeling that this US bond market has peaked, and that whilst the Fed may raise rates, well, likely to raise rates next week, and that might cause a bid in the bonds. If the market, to me, should have already had this retracement and be rallying into the FOMC with a bid coming in a lot earlier than it has. I tried to, several days ago, or back here, it tried to, but that failed, and it's now heading back down. So I don't see a bid coming in and running into FOMC. We're 10 days away from their announcement, but I don't expect much of a bid, and I would see that this bond market is actually going to come down and break this neckline. Again, if the Fed does 100 basis points, then you might see a minor bid in the bonds. But by the rumour, sell the fact, that's not happening. It did happen last time and the last couple of times. There was a bid running into the FOMC. But I think once that's out of the way, then the bond market is all over. And what that means for US dollar is that it's been attracting a lot of investors, and a lot of money has been flowing into the US bond market, and I think that the dollar index has got a lot of that flow, and some of it's based on safe haven, and that would be the only reason why, to me, this the US dollar should be bid from now on, is on the back of safe havens. But there's no reason for that. I think we're seeing a risk on environment now. People are willing to take on risk. The US earnings season is coming out, starting this week in earnest, with US companies reporting, but I think risk is certainly back on the table, and so you're seeing the safe haven assets and the bid for safe haven assets dissipate. Particularly, well, gold hasn't been much of a safe haven play recently, but certainly it's hard to find a bid in gold. Just quickly looking at iron ore as well, you can see that the potential for making steel doesn't seem to be on the cards anytime soon, with China struggling to sort of deal with a few economic issues. The GDP numbers came out this week lower than expected. So for me, the trading is not trying to take a long-term view. We might see the euro try and push back up here. Aussie, no reason to be buying the Aussie, not with commodities the way they are, but it might find a bid purely because of the US dollar selling. And I think trading the shorter term timeframes is still the better play. Trying to get a long-term trade on for a couple of weeks or a couple of months is going to be tricky as we roll out of the high inflation period and into stagflation and a recession. So it's going to be still very tricky, so still focus on the short time frames.